Next is what's going to be called prepaids. These are things that are paid ahead of time. Now you'll notice there's going to be F1 is homeowners insurance premium, 12 months it says. And then there's also section G, initial escrow payment. They also list homeowners insurance $100.83 for 2 months. Let me explain why that is. First off, when I buy a house, let's say I'm the mortgage company and you're the buyer, and you come to me and you say, I want to buy a house. It's a, you're borrowing $80,000. It's a $100,000 house. And I look at you and I go, well, I'm going to give you $80,000, but I'm not going to give you this money, to buy that house, because I'm always thinking, the bank is always thinking, what if you, move in and burn the house down the day after you move in? Now, I want to make sure that if it's I'm giving you $80,000, if it burns down the day after you move in, I want to make sure there's going to be insurance that will pay me off or cover me for that $80,000. So I'm not going to give you a loan unless I know that you're paying for the fire insurance policy that will cover you for the next year. So that's going to be F1, 1 year of homeowners insurance, fire insurance. Now, if you pay cash for a property, there's no mortgage company telling you have to get insurance. Buy a house cash, you can live there without fire insurance. We don't recommend it. The house burns down, you're out that cash, right? So that's the same thing. The bank wants to be careful. Now, what's the extra 2 months for? Well, the bank is always going to be cautious and think, well, wait, what happens if you get behind on your payments? What happens if you get behind on your payments by a month or 2 months? Okay, the fire insurance, expires. We want to make sure that you're covered. So what'll happen is your monthly payment is going to include 1/12 of your fire insurance. So if you're in this case, it looks like it's about $50 a month is what the fire insurance would be. So when you're making your mortgage payment, you're going to pay your bank $50 per month extra. At the end of 12 months, the mortgage company will have enough money to pay the next year's fire insurance. So you'll never have to bother paying your fire insurance. Your mortgage, as long as you have a mortgage on it, the mortgage company is going to make sure that gets paid because they're collecting the money, over a year. Now, again, they're worried, what if you get behind on your payments? So if you get behind as much as 2 months, they'll still have enough money a year from the day you close that they can afford to pay that insurance for you. So there's always an extra 2-month buffer that starts when you close. So you're going to have to pay 1 year's insurance plus 2 months as a buffer that the mortgage company, what they call is holds it in escrow for you. Okay?